The global markets are shifting in ways that most people don't fully realize. Right now, Japan's financial system is undergoing a profound transformation, one that could trigger one of the most dramatic reversals in global capital flows in recent history. At the same time, China is quietly reshaping the foundation beneath the U.S. gold market, altering demand patterns and influencing central bank strategies in ways rarely discussed outside specialist circles. These two powerful forces, Japan's unwind and China's gold strategy, are converging at a moment when confidence in traditional markets is already fragile. The result could send shockwaves across the global economy, affecting investors, governments, and everyday people alike. In this video, we'll break down what's happening behind the headlines. You'll learn why Japan's traditional approach to fueling global investment is fading, potentially dismantling financial structures that have stood for decades. You'll also discover why China's actions in the gold market are now more important than ever, and how this shift in gold demand could quietly challenge the US dollar's position as the cornerstone of the global financial system. By the end of this video, you'll understand how these developments could impact not only major players in finance but also ordinary people around the world. Japan's story begins with a financial strategy that shaped global markets for decades. For years, investors borrowed money in Japan at nearly zero cost and invested it in higher-yield assets abroad, including U.S. stocks, bonds, and emerging market securities. This strategy, known as the yen carry trade, created a massive global pipeline of cheap capital, supporting everything from technology stocks to emerging market credit. However, that system is now breaking down. As Japanese interest rates rise and the incentives that sustain this trade diminish, the flow of cheap money back into global markets is slowing and in many cases reversing. When borrowing costs in Japan increase, funds that once fueled international investment begin returning home. This reversal has the potential to destabilize markets that have grown dependent on decades of low-cost capital. Meanwhile, another major shift is taking place in the financial world, the gold market. China, along with other central banks, has been steadily increasing its gold reserves, pushing prices to new highs. This is not just a reaction to inflation fears or short-term market noise. It reflects a strategic reallocation of reserves away from traditional dollar-denominated assets toward gold, long regarded as a safe and reliable store of value. By accumulating gold, central banks are signaling that trust in the existing financial system may be shifting. While Japan's unwind and China's gold accumulation may appear unrelated, they are connected by a common theme: changing confidence in the global financial order. The foundation that has supported international markets for decades is being tested, and the consequences could include price volatility, exchange rate swings, and shifts in investment flows that impact portfolios and savings worldwide. Stay with us throughout this video, and by the end, you'll have a clear understanding of why these events matter, the risks they present, and why something significant may be unfolding that few will recognize until it's already underway. Welcome back to the channel. If you want to stay informed about these powerful forces shaping the global economy and how they could affect you, make sure to subscribe and turn on notifications so you don't miss our in-depth analysis. Before we dive deeper, it's important to understand the concept of unwind in finance. Unwind refers to the process of reversing large investment positions that were previously established, often because market conditions have changed or risks have increased. When many investors unwind simultaneously, it can trigger sudden and dramatic price movements. In simple terms, it's like a line of dominoes. One investor exits and others follow, creating a chain reaction across the markets. In Japan's case, the long-established patterns that have dominated markets for decades are now starting to reverse. For decades, investors relied on Japan's extremely low interest rates to borrow money cheaply and invest in higher-yielding markets abroad. This strategy, known as the yen carry trade, worked for years, fueling global investment flows and connecting Japan's policies directly to markets around the world. But now the landscape is changing. As Japanese interest rates rise and incentives shift, many investors are bringing money back home. This involves selling foreign assets, repurchasing yen, and unwinding complex positions that have accumulated over years. The scale of this reversal can be enormous. Billions of dollars can move in a short period, often accelerating suddenly and catching markets off guard. The unwind doesn't just impact investors themselves. Banks, hedge funds, and even governments can feel the ripple effects. Markets that once appeared stable may suddenly experience volatility, and assets previously considered safe can swing unexpectedly. This is particularly critical for Japan, as its long-standing financial patterns were deeply integrated into global markets, increasing the potential for far-reaching consequences. As investors reverse positions, liquidity can dry up in certain areas, causing sharp price jumps or drops. While the mechanics of an unwind are complex, the effects are very tangible, affecting everything from currency exchange rates to bond yields and stock prices, sometimes all at once. Unwinding may sound simple, but it involves layers of strategy, timing, and risk management. Investors must decide not just whether to exit, but how quickly and in what order, because every move can influence others. Japan's unwind is particularly significant because it disrupts a financial rhythm that has lasted for decades. The systems and trades built to thrive under ultra-low interest rates are now being dismantled, creating a new environment where old rules no longer apply and rapid adjustments are inevitable. The yen carry trade, at its core, relied on stability and predictability. Investors could borrow cheap yen and earn profits by investing in assets abroad, creating a feedback loop that drove capital outflows and supported global markets. Over time, this trade grew massive, with billions of dollars circulating and underpinning the strategies of hedge funds and institutional investors worldwide. But now, Japan's bond yields, historically near zero, are rising, signaling a fundamental shift in borrowing costs. The Bank of Japan is beginning to scale back its extraordinary support, changing market expectations and shaking investor confidence. As borrowing costs increase, the incentive to hold overseas positions diminishes and the profitability of the yen carry trade begins to fade. The consequences are far-reaching. Investors may start repatriating funds, selling foreign assets, and converting investments back into yen. This movement can trigger significant volatility in global markets, affecting stocks, bonds, and other financial instruments across multiple countries. Markets accustomed to predictable inflows may face sudden turbulence, and sectors that depended on cheap financing may feel immediate pressure. The breakdown of this strategy introduces uncertainty, and the ripple effects will be felt well beyond Japan, touching economies and investors across the globe. Investment models that assumed persistently low Japanese interest rates are no longer valid. Institutions now have to adjust rapidly. Some may hedge aggressively, while others might exit positions entirely, amplifying market fluctuations. The sheer scale of funds involved in the yen carry trade means that even small changes in Japanese yields can have outsized effects on global markets. Investors and analysts are watching every move from the Bank of Japan closely, knowing that the next policy adjustment could ripple through international markets, affecting prices, returns, and financial strategies in ways unseen for decades. This shift marks the end of an era when low rates effortlessly drove global capital flows, and signals the beginning of a period where markets must adapt to higher costs, shifting incentives, and the unwinding of long-established investment patterns that have shaped the global economy for years. The yen carry trade is one of the most influential financial strategies of modern markets, and understanding it is key to seeing why Japan's current changes are so critical. At its core, the trade is straightforward. Investors borrow money in Japan at ultra-low interest rates, often near zero, and invest it in countries offering higher returns, such as U.S. stocks, bonds, or emerging market securities. The difference in rates allows investors to earn a profit from the spread, making this strategy highly attractive as long as conditions remain stable. For many years, the yen carry trade became a massive engine driving global investment flows. Billions of dollars moved across borders, linking Japan's financial system directly to markets in North America, Europe, and beyond. Investors could rely on steady low rates in Japan, enabling them to take on large positions with minimal cost, amplifying gains when foreign markets performed well. This trade not only increased liquidity but became deeply embedded in global financial strategies, with banks, hedge funds, and institutional investors relying on its predictability. But now, rising interest rates in Japan are fundamentally changing the equation. As borrowing costs in yen increase, profit margins from overseas investments shrink and the trade becomes far less attractive. Once profitability declines, investors begin to act, selling foreign holdings and repatriating funds back to Japan. This large-scale movement of capital is what's known as the unwind. Unlike gradual adjustments, an unwind can happen rapidly, catching markets off guard. Massive exits can trigger sudden spikes in currency demand, sharp price drops in foreign assets, and significant volatility across multiple financial sectors. The process is unpredictable as numerous actors move simultaneously. Some exit slowly, others act immediately, creating a cascading effect that accelerates the overall unwind. The speed and scale of these movements can put pressure not just on equities and bonds, but also on currencies, derivatives, and commodities. Each step in the unwind can ripple through interconnected markets, magnifying its impact and even triggering reactions in seemingly unrelated areas. What makes the yen carry trade unwind particularly potent now is the combination of long-standing positions built over decades and the sudden reversal of incentives. Many investors have been heavily leveraged, relying on the assumption that Japanese rates would remain low. When that assumption no longer holds, the liquidation of positions can be aggressive and disorderly. Furthermore, the global nature of the trade means that as funds flow back into Japan, capital may exit high-yield markets simultaneously, amplifying volatility in the US, Europe, and emerging markets. Ultimately, the unwind of the yen carry trade is not just a technical adjustment, it's a powerful market force capable of moving trillions of dollars in a very short time. Its effects are far-reaching, influencing currencies, bonds, equities, and commodities, while creating a climate of uncertainty that can persist long after the initial movements. Investors, analysts, and policymakers are watching closely, aware that every shift in Japan's interest rates could trigger waves that extend well beyond national borders. China has been quietly reshaping the global gold market, steadily increasing its holdings over the past several years. This is not simply about stockpiling a commodity. It is a strategic maneuver aimed at strengthening its financial position and enhancing its influence in global markets. By accumulating gold, China is diversifying its reserves away from dependence on foreign currencies, particularly the US dollar, and positioning itself as a key player in the international gold market. This strategy has drawn the attention of investors, analysts, and central banks worldwide. It signals a shift in how major economies approach financial security and stability. Many central banks are now following a similar path, moving portions of their reserves into gold as a hedge against uncertainty and currency volatility. Gold has long been considered a safe haven in times of crisis, because it retains value even when traditional currencies or financial systems are under pressure. China's growing demand for gold, along with purchases by other central banks, is contributing to rising gold prices and reflecting broader unease in global markets. Investors interpret these moves as a signal that confidence in the US dollar and other traditional reserve currencies may be weakening. The scale of China's gold purchases is substantial enough to influence global prices and demand patterns. Unlike typical market speculation, these transactions are strategic and coordinated over time, designed to steadily increase holdings without triggering abrupt market swings. By building up gold reserves, China gains leverage in international finance, creating an alternative store of value that is less dependent on the dollar. If this trend continues, it could gradually erode the US's traditional dominance in the global financial system. Gold also carries symbolic power. As China accumulates more, other nations and investors may reassess their exposure to dollar-based assets, diversifying into gold or other precious metals. This shift could subtly change the mechanics of global trade and reserves, making gold not only a financial asset but also a tool of geopolitical influence. Rising gold prices, therefore, are more than market movements. They signal shifting power, confidence, and a long-term realignment of international reserves. China's approach is methodical, combining long-term accumulation with strategic market influence. By gradually increasing holdings and coordinating this with broader economic policies, China is positioning itself to challenge conventional norms of reserve currency dominance. The ripple effects are already apparent as investors and central banks adjust portfolios in response, creating a global environment where gold is increasingly central to financial security, risk management, and geopolitical strategy. Meanwhile, the US dollar and Treasury securities have long been the foundation of the global financial system, widely regarded as the most stable and liquid assets. Governments, banks, and investors around the world have relied on them as safe stores of value and as a medium for international trade. This dominance has allowed the United States to finance deficits and debt with relative ease thanks to global demand for its currency and bonds. However, persistent budget deficits and a rising national debt are raising concerns about long-term liquidity and confidence in the system. As debt levels climb, questions arise over whether the U.S. can maintain the same level of trust in its assets indefinitely, creating subtle but growing unease among investors. Gold, in contrast, has always served as a safe haven during periods of uncertainty. When confidence in traditional assets, including the dollar and treasury bonds, wavers, investors naturally turn to gold for security. Gold's tangible value and historical reliability make it a natural refuge when markets show signs of stress. In recent months, gold prices have been steadily rising, reflecting growing caution in global markets and highlighting the increasing importance of liquidity management. Investors and central banks are responding to this uncertainty by shifting more of their portfolios toward gold, reinforcing its role as a critical hedge against systemic risk. China's actions in particular are shaping this dynamic on a global scale, steadily reducing reliance on U.S. assets while boosting its gold holdings. This signals a long-term strategic shift. China's move not only strengthens its own financial security, but also has far-reaching implications for global markets. As one of the largest holders of U.S. assets diversifies into gold, it may prompt other nations and major institutional investors to reconsider their exposure to the dollar and treasury securities. This growing demand for gold could continue, reshaping both the perception and the structure of global finance over time. The impact of this shift extends far beyond simple investment choices. Moving away from dollar-based assets toward gold can influence exchange rates, capital flows, and international borrowing costs. Markets that have relied on the dollar's stability may experience increased volatility as investor confidence adjusts to these changes. This trend also reflects a broader diversification of global reserves, gradually moving away from traditional U.S.-dominated assets toward alternatives that offer greater security in uncertain times. If it continues, this could fundamentally reshape the balance of financial power, creating a more multipolar and less predictable global market, with gold playing an increasingly central role in safeguarding wealth and maintaining stability. When markets unwind rapidly, the effects aren't limited to large investors or financial institutions. They reach everyday people in very tangible ways. Stock markets, for example, can experience sudden spikes in volatility. Prices may swing sharply over short periods, making investment portfolios more unpredictable and increasing the risk for anyone holding stocks, retirement accounts, or mutual funds. Even seemingly stable companies can see their valuations fluctuate, while short-term traders may face rapid gains or losses, creating an environment of uncertainty that can feel disorienting to the average investor. During these periods, safe haven assets like gold often see heightened demand. As confidence in traditional investments wavers, investors, funds, and central banks turn to gold as a store of value. This surge in demand drives prices higher, affecting markets globally and solidifying gold's role as a key component of financial security. For individuals, this can influence the price of physical gold, ETFs, or other precious metal investment products, reflecting a broader trend of seeking security amid financial instability. Currency markets are also highly sensitive to rapid unwinds. Fluctuations in exchange rates directly impact everyday costs. A stronger or weaker domestic currency can make imports more expensive, raising prices for goods from electronics to food. Travel expenses may shift as exchange rates change, and businesses may adjust pricing in response, indirectly affecting basic services. Inflationary pressures can emerge if imported goods rise in cost, reducing purchasing power and impacting household budgets. These developments do not necessarily signal a sudden crash, but they represent a major transformation in the way money flows globally. Long-standing investment patterns and capital movements are being disrupted, while new strategies are emerging as investors react to rising interest rates, shifting currencies, and increasing demand for gold. For everyday people, this means paying closer attention to the financial environment, understanding how global shifts can influence daily life, and recognizing that stability in markets is no longer guaranteed. These developments illustrate just how interconnected global finance has become. Decisions made by central banks or foreign governments can ripple across the economy, influencing jobs, savings, and daily expenses in ways that are oft and not immediately obvious. As these forces unfold, individuals may need to adapt, whether by reassessing their investments, considering alternative assets for security, or staying informed about currency and commodity trends. The shifts in Japan and China highlight just how deeply global markets impact personal finances. Japan's financial landscape is undergoing a dramatic transformation. After decades of extremely low interest rates and easy monetary policies, the strategies that once fueled steady investment flows and global financial stability are now changing. This shift is particularly visible in the yen carry trade, where investors borrow cheap yen to fund high-yield investments abroad. As borrowing costs rise and incentives diminish, this strategy is unraveling, triggering massive movements of capital that can send shockwaves across international markets. The scale of this unwind is enormous, affecting currencies, bonds, equities, and even commodities as billions of dollars flow back into Japan and out of foreign holdings. At the same time, China is taking deliberate steps to strengthen its position in the global gold market. By steadily increasing its gold reserves, China is not only hedging against uncertainty, but also enhancing its influence in shaping global financial trends. Gold is becoming increasingly central for both central banks and major investors, reflecting rising caution about the stability of traditional assets. China's strategic accumulation has the potential to shift demand patterns and alter the way investors and governments perceive security and value in the financial system. Meanwhile, the US dollar's traditional dominance in global finance, particularly in gold markets, faces potential challenges. As more reserves shift toward gold and away from dollar-based assets, the dollar's central role may gradually weaken. This is not an overnight change, but the combination of rising gold demand, China's strategic positioning, and the gradual unwinding of global capital flows could slowly reshape confidence in the dollar's supremacy. Investors may diversify further, currencies may fluctuate more, and long-held assumptions about reserve assets may be questioned. Taken together, these developments signal a fundamental shift in global finance. Japan's changing market behavior, the unwind of the yen carry trade, China's gold accumulation, and the potential weakening of the dollar are interconnected forces that could redefine how money moves around the world. The repercussions extend far beyond large financial institutions, influencing investments, currencies, and economies on a global scale. The stage is set for a period of volatility, strategic repositioning, and a reassessment of long-standing financial assumptions as the world adapts to these emerging dynamics. Now that you understand how Japan's shifting market behavior, the yen carry trade unwind, and China's growing influence in gold could reshape global finance, we want to hear your thoughts. Do you think gold could become the new backbone of global currency? Are markets ready for what's coming, or are we on the verge of a major financial shift that most people have yet to see? Join the conversation in the comments below and share your perspective. If you found this video insightful, give it a like, share it with others who need to understand these global changes, and don't forget to subscribe to our channel. Hit the notification bell to ensure you never miss our deep dives into the forces shaping the world economy. Your engagement helps us bring more content that breaks down complex financial events into simple, understandable insights.